Good afternoon, everybody. It's David Perlmutter from Quantum Listing, and thank you for joining us today for our webinar. It's a conversation with Kent Fitzpatrick and Steve Kamen about opportunity zones, 1031 exchanges, and Delaware statutory trusts. As commercial real estate professionals, we owe it to ourselves to educate ourselves as much as possible about these instruments so that we can help our clients. Thank you for spending your time here with us today. And I'm going to throw it over to Julia to do the introductions of our two wonderful guests, Kent and Steve.
Yeah, hi everybody. So we're really excited to have Kent on for, I think, a fourth webinar, and Steve on for his first quantum listing webinar, hopefully the first of many more. So Kent is definitely your tax expert. If you have any questions, especially tax related, you want to go to him. I know I've learned a lot from him just in the last year or so, hearing him talk about 1031 exchanges, Delaware statutory trusts, and opportunity zones. Ken is going to be focusing, we're going to be focusing mainly on opportunity zones today, but touching a little bit on 1031 exchanges, and we might have some questions on Delaware statutory trust, but mostly a focus on opportunity zones, opportunity funds. So we're really happy to have Ken again for this fourth webinar. And Steve Kamen is our attorney joining Kent today for the discussion. He's co-chair of his firm's corporate practice group. As with Sills, Cummis in Newark, New Jersey. So we're really happy to have Steve as well. We do have a little blurb about each of their companies if you want to read this, but you guys can, we'll send out the deck afterwards. And Steve, feel free to jump in if you have any specific questions on, or not questions, sorry, any comments on your firms or anything you think is important for people to know about what you guys do. Now's your time to jump in if you'd like.
Well, I'll just maybe clarify. I certainly am not a tax expert, but we do a lot of tax planning. So I'll leave that to the CPAs and the LLMs in the audience to be the tax expert. So what we do wealth management and retirement plan consulting, and really got into this space, both qualified opportunity funds when the regulation came out in 2018, as well as Delaware statutory trust and 1031 exchanges, which have actually been around since 1921 on 1031s, but it was really a way of helping clients that had significant capital gains exposure to real estate, and with the O zones that we'll talk about, really addresses any capital gain. So I think part of it is really part of a wealth management planning process, and so we work in conjunction with folks like Steve and the legal side of it, as well as their client CPAs from a tax standpoint.
Awesome. Thanks for that clarification. I think he's an expert in my eyes, but I understand that clarification. And Steve, feel free to jump in a little bit just to explain what your firm does just for a minute.
Sure. Sills, Cummis & Gross is sort of a large platform law firm. We have multiple practices. Actually, real estate is one of our largest practice groups, probably the largest in New Jersey. And we do everything from land use, ground up development, financing, acquisitions, dispositions. My particular expertise is putting together joint ventures and the fund formation that's associated with that, which is how I got, into the opportunity zone, business, I should say. It's been a very robust, opportunity, if you will, for our clients. And when our clients are making demands for us to do work, we jump and become experts fairly quickly. So, Julia, that's about it for Sills, Cummis. So
yeah. All right, so we're going to get right into it. David, you're going to kick us off with our first kind of, we're going to go to the agenda, obviously. So first, we're going to kind of cover some questions on just what qualified opportunity zones and funds are. We're going to go through some of the benefits and constraints. And then we're also going to get into the differences between qualified opportunity zones and 1031 exchanges. They'll walk us through some really good charts. And also, I believe Kent has a handout that you actually will be able to download with a little bit of you'll send a text and you'll get a PDF sent to you, which is really cool. We're also going to talk about some real world examples and implementation so that this call is very helpful for you guys. You can walk out of this feeling like qualified opportunity zones and funds are something that you guys can use. They're not scary, and just get all of your questions answered. So lastly, we'll have questions at the end and just any kind of networking or follow-up at the end. So David, do you want to kick us off with our first question for our panel?
Absolutely. So Kent and Steve, just so that we all have our nomenclature correct, maybe you can sort of give us a bird's eye view of what a opportunity zone is, then maybe lead into qualified opportunity zones and qualified opportunity funds.
I can take that one, Kent. So just to give everybody just let me just take one step backward. The Opportunity Zone program was part of the 2017 Tax Act this is one of the, just for everybody's little bit of edification, one of the few pieces of, I would say, bipartisanship that you might ever see, at least in the last Congress. Actually, the sponsors were New Jersey's own Cory Booker and South Carolina's Tim Scott. And essentially, its genesis really was to help create investment opportunities in underserved communities. So what an opportunity zone is that these are census tracts that each of the governors were permitted to designate, and generally these are census tracts where income levels are well below national averages and generally underserved populations. Nationwide and throughout the U.S. territories, there's approximately 8,760 opportunity zones. For example, Puerto Rico is an opportunity zone in and of itself. So when you hear opportunity zones, it's really just a fancy word for just talking about specific geographies or census tracts that many of which are probably just located near you as well, and they're part of our underserved populations. So sometimes you'll hear the word QOZ, which is Qualified Opportunity Zone. And again, this is just a nomenclature for these particular areas in these particular communities. The other nomenclature that you'll hear is QOF, Qualified Opportunity Funds. And the only way for an investor to invest in a Qualified Opportunity Zone, QOZ, is through a QOF. So we're going to throw lots of acronyms at you. Forgive me if it's too many, but this is how the parlance has sort of developed over time. Kent, I don't know if you want to add any, and just one other thing too, I think Dave is also important, and Kent, just to kind of hear, this has been extremely popular for, it's kind of, you almost don't hear about it. I think according to the White House Council of Economic Advisors, there's been over, probably by this time, $80 billion of either actual or committed capital into qualified opportunity funds, which is just a huge number. And to even put this in perspective, and I think this is interesting for leasing professionals and other brokers, is that just by getting the designation, the land values in qualified opportunity zones have actually increased by 1%, about 1.1%. Now that may not sound like a lot of money, or a lot of value, but actually nationwide, that has been, just by those designations, about $11 billion of new value added into our communities simply by those designations. So it's already been quite a successful program, and I think that's the reason why you're seeing a lot of demand at firms like mine, and also for Kent and his services as well. So Kent, I don't know if you've got anything to add on sort of that quick intro.
Yeah, maybe.
And also, I have this slide here. I just passed through it because the second slide has some definitions. But if there's anything on this slide that you want us to take a look at, please let us know.
Julia, because just expand on Dave's acronyms. So QOZ, QOF, we'll probably use them interchangeably for this conversation. But you may also hear QOZB or QOZBP, which stands for Qualified Opportunity Zone Business or Business Property. So again, it's trying to spur investment in both businesses and real estate in these communities. And one other thing I want to expand on from Steve's point is that these were all based upon census tracts from 2010. So if you think about that, that's 10 years ago. So a lot of these areas have already begun gentrification. And in the slide you can see here, there's approximately over $234 billion that have been deployed to these defined zones, which represent over 1 million pieces of property that are in these designated zones. One other resource that you may want to see, where are these zones? Are these in my backyard, or do I own an asset, or do I have a client that has an asset? The Economic Innovation Group, which is eig.org, has an interactive map that has all 8,700 plus properties located. So you can actually type in an address and see if you have a property that happens to be in one of these zones. And to Steve and Dave's point, that just the pure fact that it's in the zone, it's getting a lot more attention, and maybe the values have gone up just purely for being in the zone. But again, to Steve's point, you can only get the benefits as an investor if you're investing in a fund, not by owning a property in the zone or buying a property in the zone. So I'll leave it at that.
You mentioned the word benefits, and I guess that brings up a good question. What are some of the federal tax benefits associated with an investment in a QOZ?
Kent, or you want me to take this one, or you can take it either way?
Yeah, I have a visual. Maybe we'll tackle this together. So Julia, if you go a couple more slides forward, or back one. No, I'm sorry. One more. Forward. Well, really, the way I like to summarize it, well, one more screen, Julia. There you go. Thank you. It's really three words: defer, reduce, and eliminate. And so if you think about it, if I take all or a portion of a capital gain, and I think the difference we'll talk about a little bit later between a 1031 and an OZ is this is any capital gain. Any 1231 capital gain is the flavor of gain that I can invest in an opportunity fund. And if I do so within 180 days, and we'll talk about, there's some exceptions to the 180-day rule as well, I get to defer paying any tax at the federal level. And if I have a state, and we'll share a map in a little bit that's a conforming state, I also get to defer the state capital gains tax for up to 5 years. If I hold it in the investment for 5 years, I will then pay a reduced tax, 10% off of what the tax I would have paid if in the year 2026, or technically when you file your taxes in April of 2027. So I'm going to defer paying any tax today for whatever gain I reinvest in this opportunity fund. I'm going to pay a reduced tax by 10% if I meet that qualification for holding it for 5 years. And if I hold the investment for a total of 10 years, then I pay no capital gains forever on the new investment. So if I had a $1 million capital gain that I otherwise would have paid, let's say $200,000 at the federal level for a 20% capital gain, and depending upon your state, Massachusetts is 5%, parts of New York are 13.3, 12.7 in the city. You could defer paying those taxes. I would get the reduction in the tax that was due. But if my $1 million grew to $3 million after holding it for my 10-year example, then I would pay no further capital gains on that new gain. So Steve, with that, maybe I'll let you clarify that.
Sure. And look, and the other thing, and so Kent, I think you did a great job of sort of highlighting, the three most important aspects of the program. The other thing I like to emphasize too for our clients is that you're also not constrained from taking advantage of all the other sort of tax advantages of being invested in real estate. For example, write down of depreciation, or for example, if you're refinancing and you want to make a liquidating distribution and the tax advantages associated with that. And the best part of this is you don't have to die, Kent, in order to get that step up in basis. And so all of that is, so when you combine, all the tax advantages for being invested in real estate just normally with those in the opportunity zone, it's very, very robust. And some of us like to, it's kind of like 1031, I think, on supercharge, Kent, is how I like to think about it. And in many different ways, particularly since the investment can be from, any capital asset, any capital gain, from whether you're selling your shares of AT&T or painting off your wall or any other kind of real estate. So I think that's what really makes the program particularly robust.
And I just want to expand on that too, Dave, because one of the things that when opportunities zones and funds were created out of the Tax Cuts and Jobs Act that you referenced, one other thing happened at the same time, and it eliminated personal property from being eligible for 1031 exchange. So I think to the example of selling my Bitcoin collection or my art collection or my stamp collection or something outside of real estate, really there's no longer an option to do a 1031 if it's eligible property, but now the opportunity zone regulations allow for that defer, reduction, and elimination of capital gain.
Great. Thanks.
Kent, do you want me to show that slide with the different states?
Oh, sure. If you want to, we can jump to that example.
We don't have to yet, but I just want to check.
No, that's fine. We brought it up, so we may as well share it with them. So the one thing that I want to maybe stress or emphasize, there's actually two versions of this nationwide map, and one is at the individual tax level. So again, I'm in Massachusetts, so it's a non-conforming state. So if I had a capital gain, I still have to pay the capital gain at the state level. Where in New York it's a conforming state, they get to defer that with the federal tax. If you could advance one more slide, Julia, I want to change gears here. The difference between these two slides is if I'm a corporation, if Steve and I own an office building together or joint assets and we have a capital gain, Massachusetts, in my example, becomes a conforming state. So depending upon how your asset is titled, and what state you're in will really depend upon whether it's conforming and you get to defer those taxes at the state level along with the federal, or if it's non-conforming and you have to pay the piper once you create that gain.
I also have this decision tree. I think you went through a lot of this, but it's definitely here you see that defer, reduce, and eliminate that you mentioned.
Yeah, I think this is really just a visual aid, and I think that, again, the difference is at the top is selling any asset that creates a capital gain, a 1231 section gain of the code, and you have 180 days to reinvest all or a portion of that gain, and so you really have two paths to follow. The one to the left, you can pay the capital gains if it's federal long-term capital gain, you've held the asset for more than a year. It's typically at a 20% level or 15% depending upon your income. State capital gains, it's a range, a high of 13.3 or a low of 0 in about eight states that don't have a capital gains tax. If it's a real estate asset, there may be depreciation recapture and also the net investment income tax at 3.8%. One thing that I will mention with an opportunity. So if you take the path to the left, we just kind of talked about defer, reduce, and eliminate. But one thing that was clarified, what you need to know that, as Dave said, these regs came out of the Tax Cuts and Jobs Act of 17, went into law January 1st of 18, but there was really a lot of unknowns or things that hadn't been addressed. And so there was actually three different cuts to try to finalize the regulation. So in October of 18, May of 19, and then the final regulations kicked in December 19th of 2019. So not even a year ago. So it was really, kind of a fresh set of final regulations. And one of the things that came out of that is before the December 19th final regulations, it was looked at that you needed to basically wait till the end of the year. So let's say if I sold a stock in January of 18, but then I had a capital loss in something else in October of that same year, really you'd have to offset your gains to your losses and then apply the net difference. With the final regulations, it allows you to take each gain separately and distinctly, which could be to your advantage, because maybe I want to create a gain, reinvest the entire gain, but then carry a capital loss use that to my benefit for my taxes. So it really was to the benefit of the taxpayer with those new regulations.
Right. So Kent, one of the things I think maybe we should, I think that toggle to is that one of the concerns a lot of our clients have with opportunity zones is that there's a 10-year hold. A lot of real estate investors really want liquidity. For example, if they do ground up development, they want to do ground up, they want to stabilize it and sell, take their money off the table, and move on. And so this is just a bit of a cautionary tale here is that in order to get the tax advantages you need, it is a 10-year hold, for this. Now there's some exceptions, and Kent, we can get into that, but I don't know, that's at least some of our clients have a concern about that, and because they do want the liquidity. And so Kent, what are you finding here about some strategies to possibly work around that 10-year? I think you just sort of mentioned one that actually could be used. I think for example, rollovers and so forth. Yeah,
that's a really good point. I think we try to take a step back and try to explain to people that if you look at the commercial real estate world in terms of slicing it into different categories, you have core plus, value added, and opportunistic. So I'll use one example. Core might be a fully leased up, stable asset, predictable income, reasonable leverage, and maybe someone is expecting a yield of, let's say, somewhere between 7 to 10%. Core plus, maybe there's some what I'll call light improvement. Maybe there's slightly more leverage. Maybe there's a 40 to 60% leverage range. And so the expectation would be where there's risk, there's reward. So maybe my reward should be a little bit greater. Maybe it's 8 to 11% range. If I kept going down that narrative with value added is probably doesn't have cash flow yet, and there's probably more leverage at the front of the deal while an asset is being finalized or constructed. So maybe the yield expectation there is 11 to 15. And then lastly, opportunistic real estate is typically more highly leveraged. Again, it's more speculative, and maybe the yield expectation would be north of 20%. So in a traditional investment, if someone's analyzing cap rates and what their yield should be, they need to understand that opportunity funds are somewhere between that value added and that opportunistic asset class, because these are, number one, they're typically properties or assets that have yet to be built. So that there's 8,700 of these sites that potentially could be improved upon, but they have to raise the capital, they have to build out the asset, they have to lease up the asset, stabilize the asset, and then generate a return for their investors. So what we're typically seeing, and it really depends upon the fund, depends upon the asset class, but if you invest in a fund, you might be getting a preferred dividend or preferred yield, let's say somewhere between 7, 9, 10, 11%, depending upon the fund and the asset class. And then there'd be some sort of waterfall between the general partner and the investors in terms of splitting any revenues above and beyond that. So when I say preferred, that basically means, let's say for the first 18, 24 months, the asset's not stable, they don't have it leased up, and they're trying to get cash flows established, but they have to build these structures, whether it's senior housing, student housing, industrial, multifamily, but there's a master plan. So you have the income, the yield side of it, but then you also have the capital appreciation side of it, which would certainly bring your total return up a lot higher. But that really is, as Stephen said, it's a long-term investment. So people have to understand that there's a patience and there's a yield play, but then there's also capital appreciation on the asset when it's ultimately sold beyond that 10-year period. Now, between that period of time, as you referenced also, Steve, is I'm getting depreciation pass through as a owner on that. So if I'm getting more modest yields, you really need to look at it on an after-tax basis, because if I'm getting a fairly reasonable offset, as probably everyone on this call is familiar, residential or multifamily assets would have a 27.5-year life expectancy, where industrial or commercial would have a 39-year life expectancy. So whatever income I'm getting, I'm still getting that depreciation pass through. And what we've seen also is because you got to pay the tax 5 years out, So someone might say, well, wait a minute, where do I get the cash flow to do that? If I've put all my gain back into an opportunity fund and it didn't start kicking off cash to me until, let's say, the end of the second year, I've got to write a check to Uncle Sam in the spring of 2027. A lot of the funds that we've seen are doing cash out refis. So again, depending upon the fund, depending upon the program, you can see anywhere from, say, 40 to 80% cash out refis, which are distributed to you as an investor tax-free. So you could basically have the benefit of getting income that you're going to be patient on. You're not going to get it right out of the gate because it is value added or opportunistic. You're going to get that depreciation offset on that income. You're passive because you're not dealing with the terrible T's, as we talk about in 1031s, tenants, termites, teenagers, and taxes. But then you're also having the ability to get the cash out refi and keep the balance of your investment long to get beyond that 10-year window.
So Kent, I think it's also, given what you just said, I think it's important to maybe go through a bit of a timeline, with opportunity zone investments. So just a little bit of background for everybody out there. With opportunity zone investments, one of the requirements of it is that you have to double the basis. So for example, if I buy property at $100, I need to invest another $100 in improvements in that property in order for it to qualify. I have to invest that within 30 months of the initial investment as well. So some of the constraints that everybody just needs to understand is that, first of all, your investment must be capital gains, proceeds. So those have to be available for you. Number two is, once they're invested, they need to be deployed within 30 months. So as we're sitting here in this pandemic, back in March, a lot of our clients were very concerned about that because, construction sites were being, delayed. People couldn't get on the job sites and whether or not they could actually manage, to do this. Now, the government stepped in and actually created some relief on many of those areas, which was very fortunate, by regulation. But I digress a little bit. So again, you have to use your capital gains, and then what happens is there now the fund, the qualified opportunity fund, can hold those proceeds for 18 months as working capital, but ultimately you do have to. This is a program for development. The prototypical is what Kent was sort of referencing, is a ground up development. Maybe you buy a piece of property where you're going to basically completely redevelop the area, perhaps into multifamily, perhaps into warehouse, whatever it may be, and then double the basis, within there. So in terms of that timeline, when that finally gets stabilized, that may be your opportunity there to essentially take your construction financing, take out your construction financing, put in a perm, and then that'll give you your opportunity to do your refi distribution. So Ken, I don't know if you want to elaborate a little bit, that maybe anecdotally from what your clients are experiencing. But
yeah, no, I think you bring up a couple of really good points, and one, I saw on the bottom of that last slide Julia had, is talking about ineligible property types, so casinos, golf courses, racetracks. One thing that was silent in the regulations was cannabis, and I think there's two sides of that, because it's a federally ineligible business, but it's kind of a gray area, and there's arguments on both sides whether or not that's an eligible or ineligible qualifying business. So I think that I would also add that because of the nature that this is ground up development, it is a 10-year investment hold. I get nervous when I hear people saying, well, I've got a buddy who's got some land out in the West, and he's going to put some condos up, and I'm going to throw in some money with it. Well, again, I would caution the investors on this call that you got to think about, number one, is the management and the team that you're going with, do they have ground up development experience in meeting those timelines that Stephen spoke about? Because there's no extension to that. Two, it is a long-term investment, so whoever you're going to be investing with, you're going to be making a 10-year commitment. So I would say that part of the due diligence needs to be looking at, you know, the management track record, their experience as a developer, and do they have the people and the systems in place to go out 10 years for this patient money.
Exactly.
Yeah, let me ask, like there's some states like New York where I've done development, and they have the State Environmental Quality Review Act, and you have to jump through untold amounts of due diligence to get your project approved. And you know, those are generally for larger projects. So does this really lend itself more to, you know, small to medium projects that aren't going to have huge you know, development soft costs and processes?
Well, let me take that, David. I mean, the ideal situation is when you have a shovel-ready project. That is the optimal. To answer your question, optimally, you might have somebody who essentially is land banking. They're doing the site work. They're getting the approvals. Then they just sell the land. They're going to get a bump just because it's in a opportunity zone, and that may be one strategy. I think it is a difficult strategy if you're buying unentitled property, and what you're trying to do then is get all your entitlements and then be able to deploy sufficient amount of your capital quickly enough in that 36-month time frame or 30-month time frame in order to get this done. So I think that is a challenge depending upon the state and depending upon the entitlement hoops that you need to jump through.
Okay, great, thank you. That is very helpful. We had a question from Samira, who's with us today, and she wanted to know, she said, I understand this is a long-term investment, but is there a generally accepted / realized return at the end of the 10-year period?
I'll take that. Julia, maybe you could flip to the slide that has a comparison of a taxable versus a opportunity fund. One more. Yeah. There you go. Come back. There you go. So we get that question a lot. And so what I wanted to kind of maybe just walk you through quickly to respond to that question is, let's say that we have investment A, which is a fully taxable investment with expected 14% internal rate of return, IRR. And we're going to use, and again, this may be an extreme example, but we're using a 36.5% long-term capital gain rate. And what that is made up of is 20% federal, 3.8% net investment income tax, which may or may not apply if it's not, if it's real estate, and then 12.7%. This was a California example, which is where this long-term capital gain example came from. The investment on the right is same thing, 10-year investment, making a 14% IRR, same capital gains tax treatment. So if I kind of walk you through the left side, so if I have a $100,000 capital gain and I have to pay my 36.5% or the number 36,496, and Julia, you can kind of bounce along with your red arrow there, then I basically have roughly $63,000 net proceeds to go and reinvest. I'm going to reinvest that and make a 14% rate of return, which after 10 years grows back to $235,000, which then I'm again going to pay capital gains tax. And again, we're assuming that capital gains rates have remained the same, even though President-elect Biden has suggested that he's looking to raise capital gains, but we'll see what happens with our House and Senate race and whether that changes. But so the net return in this example after fully paying your taxes is 5.6%. If I walk you through the same example on the far right, taking that same $100,000 capital gains, I pay no tax up front. Okay, so come back, Julia. So I am going to pay 90% of that tax, the 36,496 in 2027. So that's the $31,000. But my $100,000 over that same 10-year period grew to $370,000. So I'm paying my reduced tax 6 years into it, but I don't have an additional tax to pay after the 10-year period. So I think in this example, it's also adding back in, you can see just above the 17.8, it's adding back in an example of depreciation, because again, the income I would have received I would have been able to offset with depreciation. So in this example, and again, this could be an extreme example, and you can all get a copy of this and read the fine print, but it's showing a result that's significantly different on an after-tax basis.
Right. And again, just a little bit of cautionary tale is remember how Kent opened up here, is that the three sort of aspects of the tax: deferral, exclusion, and step up were the sort of his three hallmarks. So in that deferral, when you pay your tax in 2027, remember that you'll be paying your taxes at the then current rate. And so nobody on this phone call knows what that then current rate is going to be. It could be lower, it could be higher, depending upon how the politics go. But so that's just one aspect that you should all know about illustrations such as this, where right now we're just assuming current capital gain rates in this particular illustration.
Well, am I wrong assuming that the higher capital gain rates go, the more desirable it is to implement the strategy?
My answer would be yes, and we didn't include a slide, but I've had that question before to illustrate, if federal capital gains rates are currently 20, but let's say they go up to 30 or whatever the number could be, it still is advantageous to use opportunity funds. And one of the things I know that a lot of the folks on the call here are real estate professionals, and I've said this before, that again, this is something that if, let's say, someone didn't know about 1031 exchanges, and they messed up their 1031, they didn't get a QI, they didn't identify within the 45 days, and now they're facing the tax burden and saying, what do I do now? I didn't realize I was going to have to pay all these taxes. Our view is that the opportunity regulation allows someone a second bite of the apple to kind of manage the tax portion, which there's a lot of differences between the 1031 and the OZ, and we actually have a table that we've included here. But I think the one a couple points I'll draw out of this is you don't need a qualified intermediary for an opportunity fund, which you have to have that in a 1031. So again, if I didn't realize that, I sold the property, thought I could exchange it, too late on a 1031, you can't do it. So an opportunity fund could give you an option to manage some or all of those capital gains. Both have a 180-day window to complete the transaction. With the 1031, you have to identify exchange property within 45 days, and then close within a total of 180 days. Opportunity funds, it's the same thing. It's 180 days. But Dave, you may want to clarify this, but if I have a pass-through entity such as a partnership or an LLC, I can actually wait till the end of the filing period for that entity, and then each partner can make an individual election. So in other words, if, let's say, my LLC has to file next March 15th, and I own an asset with Steve, that at the partnership level, at the entity level, we elect not to reinvest in opportunity fund, then each of us as individual partners would then be allowed another 180 days to make an individual election. So you really can stretch out, depending upon how your asset's titled in an opportunity fund, that you really can't do that in a 1031.
There's more on the next slide, I think, right? Oh yeah.
Yeah, just some points of clarification. Again, it's different. It's really a self-certifying process for the opportunity fund. So if someone was creating a fund and they had to file an 8996, if they're deferring a gain, then again they'd have to file a different form. It's an 8949. When you're doing an exchange in a 1031, your tax accountant would have you file what's called an 8824. So this is all the tracking mechanisms for that gain, and when you get to that end of 2026 period, and then you get to the end of your 10 years, this is how the IRS is tracking that.
Right. One of the things I also wanted to emphasize, I think you were sort of touching on that, Kent, a bit, is this is not as scary as it looks in terms of implementation. And just to kind of give you a sense, is it can be anything from a self-directed fund, which translation here is a simple limited liability company agreement that you own, maybe with yourself, maybe one other member, or maybe a family member, for any amount, practically, in terms of investment. And actually, I think one of the largest opportunity zone funds that's out there right now is, institutional, and I think it's actually in the $10 billion range. But the 10 billion stuff can get scary, for implementation. But from this much smaller size, you don't need any, particularly complicated paperwork. As Kent mentioned, it's certification, and it's simply the formation of a limited liability company that its purpose is for which is investing in opportunity zones, and then effectively that tax filing 8996 on an annual basis is really all you really have to do in its simplest form. And of course, there is now, if you're the owner of the property, actually, of course, actually the fund, there is some annual testing, but just by way of example, it's nowhere near as complex and nowhere near as complicated, nowhere as burdensome, say, as, for example, REITs, which, there are specialized accounting firms that all they do is REIT compliance. That's nothing at that level here. Kent, I don't know if you've got other different experiences here, but, we've been managing it on both ends from very, very large funds to actually small self-directed funds.
Yeah, I guess what I would add to that is, the regulation has, several anti-abuse provisions. So it's really for assets purchased after 2017. So I can't say, well, I own this, multifamily, I'm going to sell it to my sister, and, we're going to substantially improve it. And so there has to be, it has to be pretty black and white. Because I know a lot of folks have approached us about that, but I think that's why you need, a good lawyer, someone like Steve, to kind of guide you through all of the hurdles if you're looking to create a self-certified fund of your own. If you're not in the market to go at your own and you want to, work with a institutional fund, that's where our organization, vets and analyzes funds. But Julie, I think you're sharing a screen that we've put out there before. And I think this was really for our real estate folks on the call. And this was really focused on some reasons that real estate professionals would want to kind of know or explore Delaware statutory trust. But I think it also applies to this conversation on opportunity zones as well, because I think it's really about being consultative. So an example we've probably shared with you before is that if I have someone who wants to sell a property, or maybe reluctant to sell a property because of the massive tax that they're going to have to pay, or maybe they're going to force me to list it with an unrealistic price because they're trying to get to a certain net number. I think as real estate professionals, if you're aware of some tax solutions, tax strategies between 1031, Delaware statutory trust, or opportunity funds that the seller may not be, I think it's a great way of you being consultative and potentially getting more listings, or being able to sell assets at a appropriate price, not letting the tax tail wag the dog.
We had another question from Samira, and interesting question. Any advice for individual investors, not the big gorillas, but folks like you and me, that are private investors that want to get into opportunity zones for the social impact, not just for making money, but for social impact? What's a better route for that? Are there social impact geared funds, or is it really more something that an individual investor could be looking at?
I can hit that. There are some of the larger financial institutions have in fact social impact funds. Goldman Sachs, for example, Prudential, and others have real estate funds that are really more designed. And I think a lot of them actually describe it as what they call the double bottom line, meaning you could actually make a little bit of money and actually do some good at the same time. Now you might be conceding some returns, but I think a lot of the parlance right now, and I've drunk this Kool-Aid for sure, is that there's definitely a way to do both, particularly as Ken mentioned in the beginning of this program, where some of these more gentrified areas, there's actually some robust appreciation opportunities that are out there, and at the same time serving the underserved communities that happen to live there and creating jobs and all the rest and the leverage that's associated with real estate development in these communities. So for getting involved, I think that in my judgment, the best opportunity is to use the leverage, if you will, that these larger institutions have, and perhaps make an investment in some of these opportunity funds that are more social impact oriented.
Yeah, I'll echo that also, Steve. Again, the core of this law, number one, is to improve the lives of those in the zone. And they're doing that through new businesses, jobs, and even aesthetic and improving value of housing there. But where's the money coming from? The money's coming from people that may not otherwise invest in these areas through benefits of a tax advantage that is creating improved lives for these zones. I mean, so these would be otherwise blighted areas that may not be of interest to any investor. So I think the doing good by doing well, or doing well by doing good, certainly goes hand in hand with any opportunity investment. But one thing I want to clarify is you only want to put capital gain monies into an opportunity fund. You don't want to put non-capital gain. That, as Steve said, there's other social responsible investments that you could do to have an impact. But I think if someone has a capital gain, they're going to pay, let's say 30 to upwards of 40% to Uncle Sam. And this is really where the genesis of this regulation came from. It was really Sean Parker, who was the founder of Napster and the first president of Facebook. He had a significant capital gain tax that he was going to cut, and basically he was the one that funded the Economic Innovation Group that became the think tank, if you will, that got the Cory Booker and Tim Scott involved in this. So really the genesis of this was to improve the lives for folks in these zones. So I think directly by investing in an opportunity fund, you are doing that. I would say, to Steve's point too, that look at the different funds, look at the different investments. Some of these are doing better social impact than others, and I'd say buyer beware. Do your homework, do your due diligence.
Cool.
Thanks. So I have a question for you guys. Is there a leasing strategy that you can be used in the opportunity zone context?
Short answer, Dave, is yes. Now, one of the things, and actually, it's something of a workaround, because one of the things, the restrictions in opportunity zone investment is what they call related party transactions. So short version is you can't sell, take your property and sell it to yourself, or retain a 50% interest in that property under this particular program. That's actually, so that's called related party transactions, and those are prohibited under many aspects of the tax code. However, those related party transactions do not apply to leasing transactions. So for example, you can do ground leasing and other types of strategies like that work actually very well in this particular context. So the short answer is a real estate interest that can be the subject of an opportunity zone can be a ground lease.
And so how do you, walk that fine line? Are there, tips you would give, and landmines we should avoid there?
Well, look, the thing about it, these leasing strategies, and like any other related, they have to be arm's length transactions. You can't upfront, the rent by more than a year. So it actually has to look and smell. When back in law school, my law school professor said, if it looks like a duck, it quacks like a duck, it's probably like a duck. Well, here you have to make sure that it looks like an arm's length transaction. It waddles like an arm's length transaction. And so if it ever got audited, you wouldn't ever be, in that hot soup or not. So The real trick here is to probably get third parties to evaluate your transaction. If you're doing that, making sure that it's arm's length and that he can sign off. And I think actually that's an opportunity for the broker community out here for those kinds of services which may be associated with that kind of transaction.
Can you commingle when you're investing opportunity zone funds and non-opportunity zone funds in an asset?
Short answer is yes, so long as again, the property has to be in an opportunity zone. So if you have a fully qualified opportunity zone, but on the other hand, you have investors who just simply like the opportunity, like the investment, like the returns that they're seeing there, but don't have capital gains to otherwise invest, they can actually form another investment vehicle and invest into that property. What you can't do is commingle it within the same fund. So in corporate speak, we sometimes call that a sidecar or an alternative investment vehicle, and those kinds of strategies can be implemented, and we've definitely have seen that many times. Particularly if in these areas where, again, we like to call it the low-hanging fruit, which is these are basically construction deals. They're penciling out great. They pencil out wonderfully, not even without the tax benefits that are associated with opportunity zones. And many investors are eager to put in not only capital gains, but other types of cash proceeds as well.
Yeah, one other thing, Dave, I'll add to that too, is that most of the funds that are structured out there are either 506C or 506B, which typically means you have to be an accredited investor. So other than the fact that if I'm going to go create my own fund, raise my own capital, and invest capital gains into that, if I'm looking to invest in a fund that's already been created, professionally managed, typically you have to be an accredited investor, which means that I have a net worth exclusive of my personal residence of at least $1 million, or income of $200,000 a year for the last 2 years, or $300,000 as a couple. So because these are illiquid investments, so the SEC and FINRA, so forth, the regulatory bodies want to have people that are aware of the commitment that they're making. So I don't see folks investing anything other than capital gains, and if you're working with an institutional fund, as Dave was saying, they're going to only allow capital gain monies into the fund, and they may have a sidecar for something outside of that. But within the opportunity fund itself, it typically would be restricted strictly to capital gains.
Great. Can you add, if you're doing an opportunity zone development project, can you leverage state or federal subsidies like low income tax credits or things like that?
Kent, you want to? Well, either way, what I can tell you is that there's been almost every community that we're working with in New Jersey, whether it be Elizabeth, New Jersey, or Newark, New Jersey, or in any of these communities, they all have, if you will, people dedicated in task forces that are there to help opportunity zone investors leverage their investments. So it might be Economic Development Authority money, in the state of New Jersey, and other similar types of governmental authorities that are encouraging to use those state funds and leverage them on top of opportunity zones. In addition, federally, there's many other opportunities as well, where the federal government is working with in these census tract areas in order to develop them and throwing other types of money into it. So there are lots of different programs, and this kind of, if you will, I like to call it sort of capital stacking, if you will, bringing in different funds, whether it be from opportunity zones, governmental subsidies, other tax subsidies. Many of these local communities are really catching on quite well and helping investors and helping sponsors and helping developers, put all this together in order to make it work, because many of these projects can be very expensive because you might be doing infrastructure, and you might be, or just simply it's, construction costs are very high depending upon what the jurisdictions are, and they need as much help as possible. And of course, all of that, again, boost returns for your investors in the long run, which is great.
Thanks. Well, we're actually coming up on an hour, which is shocking because it just flew by. Is there anything, Kent or Steve, that you would like to wrap up with? And also, please let us know how we can get in touch with you if we have further questions or want to engage your services. Oh, there it is. It's right there on the screen. Man, you're good. Well,
I'll just speak. I just want to thank everybody at Quantum Listing. Really, this is for everybody. If you're not familiar with them, they're one of those really hot, PropGo, type of, not, or prop tech, I should say, startups.
Prop on the go.
Yes, it's incredible. And I think that you're going to see a lot more of this group, I think, as they grow and do better. And I just want to thank Dave and Julia for the opportunity to be able to speak, to your user base, and share some of our experiences, with them and with you. And Kent, it was great sort of co-moderating this with you. First time we got to work together, so I really appreciate it.
Yes, thank you, everyone. Appreciate it.
Okay.
Thanks, guys. Yeah, Kent, did you want to speak about this Ozone's website, or we can just share it in the deck? I didn't want to pass through it.
Yeah, those are two resource sites that we put together for both opportunity zones, kind of some of the things we talked about, some of the basics, as well as Delaware Statutory Trust, 1031 exchanges. Both of those sites, if someone is accredited investors, wants to see the type of funds that we screen, monitor, do due diligence on, they can request access once they're affirmed to be an accredited investor and get into a secure site to look at different funds.
Cool.
All right. Well, thank you, Steve and Kent, and I really appreciate your giving us your expertise and time today, and to everybody watching today in real time or on their own time watching the replay. Thank you also, and of course thank you, Julia, for coordinating this and putting this together. Nothing happens here at Quantum Listing without Julia's thumb on the switch, so good job.
Wouldn't exist without you, though, so thank you.
All right, thanks everybody.
Thank you all.
Thank you all.